Welcome to PIMCO Pod. In this episode, we discuss how the transition from bank-dominated lending to a diversified financing ecosystem offers unprecedented opportunities for private credit investors. Stay tuned after the conclusion of the podcast for additional important information. Private credit. Asset-based finance shines as lending landscape evolves, by Chris Kraus, Heron De Silva, and Jason Steiner. Key takeaways. Asset-based finance is one of PIMCO's highest conviction investment themes, with a market valued at over $20 trillion. While a broad universe, key sectors include residential mortgage lending, U.S. consumer lending, aviation finance, and data infrastructure. We expect banks to continue operating in a more restrictive environment, prompting them to seek additional capital partners and prioritize non-balance sheet lending alternatives. High barriers to entry and the need for specialized expertise create a competitive advantage for investors with established capabilities in these evolving markets. Asset-based lending has become an attractive alternative to traditional direct lending as banks navigate evolving capital requirements and seek to optimize their balance sheets. With investments secured by tangible assets, the sector is bolstered by underlying trends in key areas. One is the strength of the U.S. consumer, with robust household balance sheets and high homeowner equity. Another is the investment in data centers, spurred by rising demand for cloud computing and advanced data processing. Since the global financial crisis, GFC, banks have faced a succession of challenges, including stricter regulations, changes in loan accounting, and a rapid rise in interest rates that is just beginning to reverse. These factors have affected capital requirements and increased the cost of lending, prompting many banks to trim their balance sheets, prioritize certain types of lending, and focus on risk mitigation. The Basel III regulatory framework was developed in response to the GFC to strengthen the supervision and risk management of banks. Following the regional bank crisis in March 2023, we expect banks, particularly large regional lenders, to face a restrictive environment, even as the incoming U.S. administration may relax regulations more broadly. Regulators are considering a revised framework known as Basel III Endgame in the U.S. and Basel IV globally that could increase capital requirements. As they await clarity on new regulations, banks, and importantly, bank shareholders, are focused on long-term, stable profitability. To achieve this, they are reducing the proportion of loans with high capital charges and loans that drive higher earnings volatility. We believe this is prompting banks to seek additional balance sheet partners that can provide strategic capital and/or non-balance sheet lending alternatives. This disruption is opening opportunities for private capital across a range of asset-based markets, which offer attractive starting valuations and favorable fundamentals, especially when compared with private corporate markets. We believe investors today can find better compensation for risk in asset-based finance, given significant capital formation in lower-quality private corporate credit. What might seem like a recent rise in asset-based finance is in fact part of a long-term shift that started with the banking sector's deleveraging 15 years ago. At PIMCO, we have been at the forefront of this trend. Recent interest reflects a broader recognition of the asset class's growth potential and aligns with investors' growing need to diversify income sources beyond traditional corporate-skewed credit allocations. Private capital is now increasingly able to collaborate with banks, offering solutions while seeking to generate attractive risk-adjusted returns. These collaborations can take the form of portfolio sales, partnerships on new originations that allow banks to retain customer relationships, or customized transactions known as synthetic risk transfers, SRTs, a type of securitization where banks shift risk from their balance sheets to other investors. Asset-based finance, one of PIMCO's highest conviction investment themes in private credit. Asset-based finance, also known as specialty finance or asset-backed lending, is an attractive and less crowded asset class bolstered by favorable trends in the evolving banking landscape. We estimate the asset-based finance market, excluding commercial real estate lending, to be valued upwards of $20 trillion. Asset-based sectors in both consumer and non-consumer areas provide appealing opportunities for private market investors, particularly relative to corporate lending. For more, see our September cyclical outlook, Securing the Soft Landing. Sectors such as consumer lending, including residential mortgages, personal loans, and student loans, offer robust long-term fundamentals and attractive value, especially as U.S. household balance sheets are much healthier post-GFC and the housing markets remain well-supported. We also have high conviction in sectors with significant secular tailwinds, including aviation finance and data infrastructure. Our conviction is backed by the well-established architecture for sourcing, analyzing, structuring, financing, and managing various asset types. In our view, high barriers to entry mean that successful investment requires deep infrastructure throughout the value chain. These are our highest conviction investment areas within asset-based finance today. 1. Residential mortgage lending. The residential mortgage market is the largest component of the asset-based investment opportunity set, supported by several compelling trends, including leverage in the U.S. and U.K. housing markets that is lower than historical norms. However, at this point in the cycle, we remain focused on affordability amid higher prices and low inventory across submarkets. Due to stricter post-GFC regulations, non-qualified mortgage, non-QM loans, aimed at borrowers who may not meet the requirements of standard loan programs, such as self-employed individuals, property investors, or non-residents, represent a growing segment of the U.S. housing market. These loans benefit from a robust equity cushion given relatively low loan-to-value (LTV) ratios, tighter underwriting standards, and home price tailwinds amid strong demand from millennials and a housing undersupply. With mortgage rates potentially remaining elevated and homeowners with lower rates reluctant to move, we expect attractive opportunities in the second lien market. 2. U.S. consumer lending. Consumer lending outside of residential mortgages represents a sizable opportunity, with over $17 trillion in U.S. household debt, including personal loans, student loans, and credit card receivables. Despite higher interest rates, household balance sheets remain strong, with debt-to-income ratios declining in recent years and net worth near all-time highs. Debt servicing costs remain low by historical standards, largely because about 95% of American mortgages are fixed rate. While higher delinquencies are often seen as signs of U.S. consumer weakness, not all U.S. consumers have similar credit profiles. Delinquencies have risen significantly in the subprime segment, but those in the prime and near-prime categories have normalized to pre-COVID levels. Additionally, many lower credit consumers experienced a temporary and artificial boost to their FICO scores due to pandemic-era student loan forbearance and fiscal stimulus, which has since led to increased delinquencies. PIMCO's large, granular U.S. consumer credit database stretches back to 2005 and encompasses an estimated 35 to 40 billion anonymized data points, helping us understand consumer behavior through the cycle and pinpoint the most compelling loan pools. 3. Aviation finance. Capital needs continue to grow in this sector. Barriers to sourcing and servicing the underlying collateral remain high, while the collateral itself exhibits strong fundamentals. The aviation industry has faced substantial disruption from the pandemic and the Russia-Ukraine conflict. However, after taking on $250 billion in incremental debt, airlines returned to profitability in 2023 by focusing on cost-cutting and increasing fleet capacity to meet increasing travel demand, with revenue passenger kilometers, RPKs, surpassing pre-COVID levels. Production issues and a persistent backlog in aircraft manufacturing have limited the availability of new planes, with original equipment manufacturers delivering 35% fewer aircraft, 4,200 planes than ordered from 2019 to 2023. With this supply and demand imbalance growing, we believe lease rates on new and mid-life aircraft offer attractive yield and income potential. 4. Data infrastructure. Demand for data centers has been surging, driven by increased connectivity, cloud computing adoption, large language models, and the rapid evolution of generative AI technologies. And the supply of capital is not keeping up. Companies need robust infrastructure, including both data centers and high computational GPU chips, which require significant capital investment. Banks have had a very limited footprint in these markets, specifically in lending to companies looking to buy new chips. We see numerous opportunities to develop bespoke financing solutions that can benefit from underlying collateral, including chips, network infrastructure, or contractual future cash flows derived from customer contracts. Focus on relative value is paramount in private credit. As demand for capital outpaces supply across several sectors, investors stand to benefit from a diversified approach to private credit. Over cycles, we have regularly seen certain markets experience inflated pricing. At PIMCO, we consistently apply a relative value lens to aim to avoid value traps. We believe it is important to approach certain sectors with caution given significant capital formation or hidden risks that have yet to be tested. These are some of those areas. 1. Music royalties. An emerging sector within asset-based finance, music royalties are attracting interest due to their uncorrelated returns. However, we believe dedicated capital has generally left less value in the sector amid expanding multiples and astounding valuations for some high-profile deals. While music royalties offer strong recurring income, we remain selective, focusing on smaller catalogs with under-monetized assets. There are also opportunities to acquire catalogs from lesser-known industry participants, example, mixing engineers, which may provide similar cash flows at significant discounts. 2. Synthetic risk transfers, SRTs. For the past 15 years, banks have been frequent issuers of SRTs, mainly in Europe, to manage credit risk on their balance sheets. Until 2023, these trades were noticeably absent from the U.S., but the U.S. market has quickly evolved, with 2024 on track for record activity. With the influx of dedicated capital, valuations in the U.S. SRT market have tightened significantly. While SRTs provide an efficient way to access high-quality bank-originated credit, we do not consider them a standalone asset class. Instead, they represent one of many ways investors can gain exposure to the underlying collateral, such as residential and commercial real estate, consumer-related areas, and corporate assets. We see SRTs as an attractive means to access certain asset classes when whole loans are less accessible, trading at rich levels, or offer less scale. Our strategies will constantly shift between SRT and other formats as relative values evolve, or as strategic factors, like bank capitalization levels, affect pricing. 3. Newer consumer loan products. While we remain constructive on broader personal lending, we believe emerging shorter-term products, including Buy Now, Pay Later, BNPL loans, are still maturing. BNPL loans allow customers to buy products and services without paying the full amount upfront, providing financial flexibility. However, we have limited insight into origination practices, as many active originators do not conduct thorough underwriting or share reporting with credit bureaus. Our approach to investing in consumer loans emphasizes granular underwriting, requiring extensive loan-level datasets to drive our analysis. Balancing optimism with cautious evaluation. As a long-standing investor in asset-based finance, we are excited about the sector's evolving opportunities. What was once a market dominated by banks is becoming a more diverse financing ecosystem that has historically included securitization markets and increasingly involves private lenders. This shift presents one of the most compelling opportunities for private credit allocators in over a decade. However, this optimism must be tempered with discipline. Investors should be aware of the varying fundamentals and valuations across asset-based finance areas, particularly in sectors with uncertain collateral values or weak documentation that could undermine credit performance. At PIMCO, we continue to take a relative value-oriented approach to the array of opportunities generated by our origination platform. By leveraging our multi-decade head start in building data sets, as well as our analytics framework and macroeconomic insights, we strive to uphold rigorous discipline in underwriting and portfolio construction. The same principles that have driven our success in public and private markets will remain essential in navigating the future of asset-based finance. Thank you for listening. That was Private Credit. Asset-based finance shines as lending landscape evolves. For future insights, please follow us on your favorite podcast platform. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be, and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.